Hello friends, welcome back to my show. In this short video, I will teach you how to create your own Sensex linked equity fund. The advantage is that your investment will automatically track the Sensex and you will pay zero fund manager fees, and at the same time you will earn dividend on your shares. The question that you will ask is, why should I invest on the Sensex index? The answer is very simple. It gives you an assured return on your investments. Just take a look here for the record of past 5 years. Out here you will see that the Sensex has risen by 28,718 points. That's a whopping 85.82%. Or if you take the cumulative annual rate, it comes to 13.19%. Just compare that to the fixed deposit bank rates that you get, and plus remember you pay income tax on the interest that you earn on such fixed deposits. If I do a quick simple calculation, the index on 15th of December 2017 was 33,462, and the calculation is right in front of you. 10 lakhs invested on 15 December 2017, which is 5 years ago, would have grown to 18 lakhs 58,257 rupees at the rate of 13.19% annual interest. This is absolutely guaranteed if you follow the instructions of this video. You're bound to ask the question that the Sensex goes up and down quite a lot. Take a look at a short-term investment return. This graph plots the Sensex for the past 6 months, and as you can see that it has risen by 17.66% in the past 6 months. That is equal to 9,334.97 points of the Sensex, which is a wonderful return. Now we'll discuss the concept of multiplying factor. This is something that you're going to use every day. Suppose you have invested an amount of 20 lakh rupees today when the Sensex was at 61,181. The multiplying factor is simply 20 lakhs divided by 61,181, which roughly translates to 32.68. So now, in order to check your investment worth, simply multiply the Sensex at that moment by 32.68. And if you go and check your balance, you will find that this works perfectly. You will have to now create an Excel sheet. This Excel sheet will have different columns. In the first column is the name of the stock. These are 13 number. What you see on the screen are only the first 15 in alphabetical order. The next column is the price column. Copy this from the BSE Bombay Stock Exchange website and enter it for each company. The next one is the free float market cap, and I'll tell you how you obtain this value from the BSE website. For each company, fill it out. The next column is a total market cap for the 30 shares and is shown by the Sigma M cap caption. This will be the same for all the rows. Then you calculate the fraction, the amount or the fraction of your total investment which will be put into this particular stock. So for that you will be dividing the third column, which is free float market cap, and dividing it by the Sigma market cap or the total market cap for the 30 stocks. This gives you the fraction. The next column is portfolio, which is the total amount that you want to invest. In our example, it is 20 lakhs. The next column is the amount to be invested in each stock. This portfolio column will reflect 20 lakhs for all the rows. The invest column will be how much you are investing in this particular company stock. And this will be a calculation based on portfolio amount 20 lakhs multiplied by the fraction. And then what you do is you calculate the number of shares. The number of shares is calculated by taking the investment amount for that particular stock and dividing it by the price, which is the second column. This will give you shares in fractions. You will have to round them off to the correct decimal value of two significant figures only. We shall see how we do that when we go further. Now you have to do the data collection for the spreadsheet which we have produced earlier. Go to this URL and this is what you will see. In the next slide, we shall see an expanded view of the same. Here is a close-up view of the 30 stocks which are shown on the page. What you see in that little red box is the selection of the view. Make sure you have selected the alphabetical list as shown on the screen, because that is how we have constructed the Excel sheet. So please ensure that it is not the default view, but it is the alphabetic view. Now go to each stock individually. For example, if I hover my mouse on Asian Paints, I will see this mouse finger, and I take my mouse finger and click on Stock Reach. I will show you what it looks like after you click on this particular Stock Reach icon. Once you click on Stock Reach, you will reach this page for Asian Paints. Let us see how we are going to use data on this page. Here is a close-up of what we saw on the previous slide. What is of interest to us is the current price of the stock. We usually create this Excel sheet at the end of the day's trading so that we get a steady value. Otherwise, throughout the day, this value is going to fluctuate. In our example, the Asian Paints stock closed at 3,227 rupees and 40 paisa only. Make a note of this or simply copy and paste it on your Excel sheet in the price column. The next thing which is of interest to us is the free float market cap, and you will find it in the third box from your left, and it is the fourth entry, which is highlighted by this red box. What it shows is that the free float market cap for Asian Paints is 1,45,498 rupees and 60 paisa in crores of rupees. This is of interest to us, and we fill it in the next column, which is the FFM cap column. I already explained how you construct this Excel sheet for the 30 stocks. We saw that the first column was the names of the stocks, and then we filled up these columns, which was for price, free float market cap, the sum or the total of the market cap for 30 Sensex stocks. Then we saw how we are calculating the fraction. Then we entered 20 lakhs as the amount of the total portfolio, which is the same for all the stocks. And then, of course, we put in a formula to calculate how much I am going to invest in each stock, which will be the portfolio amount, 20 lakhs, multiplied by the fraction. The fraction is calculated by dividing the free float market cap for that particular company by the total market cap or the sigma market cap. Now, what I do is I calculate how many shares I need. Since I know how much money I'm going to invest in each company, all I do is divide the investment amount, which is the second column from the right, by the price, which is the first column inside the red box. That gives me the total number of shares. Now this will be a fractional amount. For example, Asian Paints, I will be investing 41,318 rupees, and I can buy 12.80224 shares. In India, we cannot buy fractional shares. We go for calculating the next higher or lower whole number based on the simple formula that anything equal to or more than 0.5 will be the next higher whole number. Anything less than 0.5 will be the next lower or the previous lower whole number. So now I make an entry of the total number of shares which I need to hold in this column. I transpose the total number of shares into the hold column as a whole number. Then, if you're investing for the first time, the total number that you buy will be the same as that which you have to hold. Otherwise, you fill in the number held as 0. Hold is of course entered by you manually by rounding it off to the next whole number, and buy will be equal to hold minus held. Let us see how this chart looks like after having done all this. This is what the Excel sheet will look like for the first 15 stocks of Sensex. This is the Excel sheet continued for the next 15 scripts. Remember, there are total 30 which constitute the Sensex. That's it. Your job is done. Now here is a summary of the salient points of this video. First of all, create an Excel sheet as was demonstrated. Next, go to the Bombay Stock Exchange or the BSE website. Collect the data, and we need two data entries. One is the price and the other is the free float market cap. Now you calculate as was demonstrated in the video on the Excel sheet and simply buy and watch your investment grow. It's as simple as that. So friends, that brings me to the end of this video. This video was based on strategies described in the Little Book of Common Sense Investing by Jack Bogle. Jack Bogle was an eminently successful investment banker and the founder of the Vanguard Group, the first mutual fund to cross the 1 trillion mark and also the first one to cross the 5 trillion mark. Jack Bogle died a few years ago in 2019, but his method is available to us for everyday use. I too have been following this method for over 15 years now, and I have never looked back or repented. So I wish you the best of luck in your investment journey. Stay safe and earn well. Thank you and bye-bye.